Welcome to Iron Financial. This is the place where we forge stronger portfolios, and we do it by stress testing companies and cutting right through the market noise. Look, today, we are not chasing some high-flying tech stock with a fancy story. Nope, we're going where most of the market isn't even looking. We are cracking open the latest earnings report from HealthEquity, ticker HQY, and we're going to find out if there's solid steel hiding under the surface or if it's all just a brittle facade. Let's get to work.
All right, I know what you're thinking. Health savings accounts? Really? In a market that is just completely obsessed with AI, with crypto, with the next big thing, why on earth are we spending our time on a company that, let's be honest, manages healthcare spending accounts? It sounds about as exciting as watching paint dry. And you know what? That's a fair question. But here at Iron Financial, we hunt for strength where other people refuse to look. We search for financial fortresses being built right out in the open. And sometimes, the most durable, cash-gushing machines are found in the most boring, unassuming sectors.
And this is exactly why. This one quote, right here, from HealthEquity's CEO on their last earnings call, this was the signal flare that got our immediate and undivided attention, the Rule of 50 Club. Now, that is not just some fancy corporate jargon. It's a benchmark for truly elite performance. It's a screaming signal that a company is firing on all cylinders, hitting rapid growth and huge profitability at the exact same time. It's a club that's usually reserved for the absolute best of the best. And HealthEquity, they're not just a one-hit wonder. They've been in the club for 3 years, and they are guiding for a fourth. That, my friends, demands a much, much closer look.
So, let's hammer this out. What exactly is this Rule of 50? It's a surprisingly simple but incredibly powerful formula for getting a read on the true health of a business. It's like a financial stress test. You take the company's year-over-year revenue growth percentage and you add it to its Adjusted EBITDA margin percentage. For those of you who might be newer to this, EBITDA is just earnings before interest, taxes, depreciation, and amortization. It's a really clean way to see a company's core operational profit. Now, if you add those two numbers together and they're over 50, you are looking at a very rare breed of company. It's not just growing by burning cash, and it's not just profitable by standing still. It's doing both, and it's doing them exceptionally well. This metric is the foundation for our entire analysis today.
Okay, so here's the blueprint for today's drill down. First, we're going to put on our hard hats and examine this so-called Rule of 50 fortress and see if it's really as solid as they claim. Then, the analyst is going to take us deep into the engine room to see how they're forging this elite level of profitability. After that, we'll look at the plans for the future, how they're building new pillars for growth. And then comes the important part. We're going to stress test the entire foundation, and we're going to hammer on the biggest potential crack in the armor, interest rates. Finally, we'll lay out the full blueprint and deliver the Iron Financial verdict.
Right. Let's start with that foundation. This isn't about one good quarter or even one good year. We are looking at the core, the underlying strength of the business model itself. And that Rule of 50 status? Well, that's the bedrock of what we're calling the HealthEquity Fortress. It's a huge claim of elite status, and our job is to get in there and verify if it's built to last.
You know, hitting this benchmark for 1 year is impressive enough, but to hit it for 3 straight years and then tell Wall Street you're going to do it for a fourth, that signals something much deeper. It points to a powerful, incredibly scalable business model. The company calls it their flywheel effect. Think about it. As more members and more of their assets join the platform, the company's big investments in technology and automation start to pay off in a huge way. Every new account they add costs them less and less to service. So as their assets under management scale up, their earnings don't just tag along, they actually accelerate. This is the very definition of a high-quality, scalable platform business.
Okay, analyst, I gotta jump in here. Rule of 50, flywheel, is this just fancy Wall Street talk? Are we talking about real tangible strength, or is this just a great story they're spinning for investors? I need you to ground this in reality for me.
That's exactly the right question to be asking. Let's ground truth this with a hard, cold number. Let's talk about the PEG ratio. This metric takes a company's price-to-earnings ratio, a classic valuation metric, and it divides it by the company's projected earnings growth rate. Now, anything under 1 is generally considered a sign that a stock might be undervalued. HealthEquity's PEG ratio is a stunning 0.35. That's not just a little undervalued, that's incredibly low. It suggests that despite all this elite operational performance we're talking about, the stock might be trading at a massive discount to its growth. So no, this isn't just a good story. The valuation metrics themselves are screaming that the market might be completely asleep at the wheel on this one.
Okay, so we've established the foundation is solid. Now, let's move inside the fortress and inspect the engine itself. How exactly is HealthEquity forging this level of elite profitability? Because let me tell you, a company does not just stumble into the kind of margin expansion we're about to look at. This is deliberate, this is engineered, this is by design.
Just look at the sheer scale of this jump. This chart says it all. Their gross margin expanded from 61% all the way up to 68% year over year. That is a massive 700 basis point improvement. For anyone new to the lingo, 100 basis points is 1%. So we're talking about a full 7% increase in gross margin in 1 year. In the world of corporate finance, that is a tectonic shift. It tells you that for every single dollar of revenue that comes in the door, a whole lot more of it is dropping straight to the bottom line. This is the real-world result of that operational leverage, that flywheel effect we just talked about. This is the proof.
Now let's break that down even further. Where is the real muscle coming from in this growth story? You see their service revenue, that's basically their account administration fees, it's growing at a slow and steady 2%. Interchange revenue, which is the fees they get when members use their debit cards, that's up a pretty healthy 6%. But look at the real heavy lifter here, custodial revenue. This is the income they earn on all the cash that members hold in their accounts. It's up a massive 12% year over year to over $161 million. This is now their largest and their fastest growing revenue stream. And here's the kicker. It is extremely high margin revenue.
Whoa, hold on a second. A 12% jump in one revenue stream, even if it is a high margin one. That doesn't fully explain a 700 basis point explosion in gross margin all by itself. There has to be more going on here behind the curtain. How are they manufacturing this kind of profitability? This can't just be coming from the revenue side. They have to be doing some serious work on their cost structure to make this happen.
And that is the answer. Management used a specific phrase on their call, a maniacal focus on AI and automation. And the results? Well, they're undeniable. They have absolutely crushed their fraud costs, taking them from 1.1 basis points of their assets annually down to a current run rate of just 0.1 basis points. That's a more than 90% reduction in losses from fraud. It's incredible. They are relentlessly pushing members away from expensive human-staffed phone calls and onto efficient digital channels, with over 3.6 million app downloads to prove it. Every single automated process, every digital interaction, it just drives those margins higher and higher. They are systematically building a lean, technology-first cost structure that is designed for massive scale.
So we've got a solid foundation and a powerful engine. But a fortress that just stands still is eventually going to be a vulnerable one. To truly endure, it has to expand. And that brings us to our next section, the new pillars that HealthEquity is building to secure its future growth. They're not just defending, they're on offense. Management is absolutely not sitting still and collecting checks. They've very clearly laid out two major new growth initiatives that are just now beginning to ramp up. First, they are making a really strategic push into the Affordable Care Act, the ACA, exchange market. And second, they've launched their brand new HealthEquity marketplace. Now listen, these aren't just minor tweaks to the business. These are calculated, strategic moves designed to significantly expand their total addressable market and create entirely new streams of revenue. Let's dig into that ACA opportunity first. For the very first time, people who are on certain ACA health plans can now enroll directly in a health savings account without needing an employer to sponsor it. This is a complete game changer for them. It breaks HealthEquity out of its traditional B2B model, where they were only selling through employers. This one initiative represents a potential 10% expansion of the entire addressable market for HSAs. They are literally kicking down a brand new door to a whole new class of customers in the individual market.
Okay, a 10% market expansion, that's a big number. But this second pillar, this marketplace idea, it sounds even more ambitious. Are these just growth stories they're telling Wall Street to pump the stock, or is there real substance here? How real is this? Oh, there's substance. A 10% market expansion is big, but you're right, this second pillar could be even bigger. The company has launched its own marketplace, where it's offering services like weight loss programs, hormone replacement therapy, healthcare wearables, directly to its millions of members. This is not a small bet. The estimated annual consumer spend on just the initial services they're targeting is over $100 billion. Let that sink in. They're building a platform to capture a slice of that massive spend. They're moving beyond just being an account administrator and are trying to become a true healthcare commerce engine.
All right, analyst, it is time to play devil's advocate. We've seen the fortress, we've inspected the engine, we've reviewed the expansion plans, and I'll admit, it all looks incredibly solid on the surface. But every structure, no matter how strong, has a potential point of failure. And for HealthEquity, the market has always believed that weak point is interest rates. So now, we are going to stress test this foundation. We're going to kick the tires hard. So let's be blunt.
That 12% growth in custodial revenue looks fantastic when the Federal Reserve is hiking rates. But is this entire fortress that you've described, is it all built on the shaky ground of Fed policy? What happens when the Fed inevitably starts cutting rates? Does that high-margin revenue stream, their biggest and fastest growing, does it just evaporate into thin air? Does the entire investment thesis crumble to dust? This is the #1 bear case against this stock, and we absolutely have to tackle it head-on.
This, right here, is where the story gets really interesting. Management isn't ignoring this risk. They're not sticking their heads in the sand. They have been actively and systematically dismantling this risk for years. The key is what they call their enhanced rates contracts. These are long-term agreements they have with their banking partners, and they're specifically designed to smooth out interest rate volatility. As of the end of last year, 58% of all their members' cash was already locked into these new, more stable contracts. And they're not stopping there. The CFO said they expect to push that number all the way up towards 80%. This is an active, deliberate de-risking of their most important revenue stream.
This slide perfectly illustrates the strategic shift they've made. The old model was extremely volatile. Their earnings could swing wildly based on what the Fed was going to do next, and that created a ton of uncertainty and risk for investors. The new model, however, is built for durability. The yield they earn is no longer tied to whatever the short-term rate is today. Instead, it's based on a 10-year moving average of the 5-year Treasury yield. This completely smooths everything out. A 1-year dip in rates barely even moves that 10-year average. They are fundamentally transforming a volatile, market-dependent revenue stream into a predictable, stable foundation for the entire business.
And hey, don't just take my word for it. This is their CFO, James Lucania, spelling it out in the plainest English possible on the earnings call. He said the explicit purpose of this was to, quote, reduce the standard deviation of these returns, and his ultimate goal? For investors to see custodial revenue as, quote, just monthly recurring revenue, no different from their stable service fees. This is a profound change to the DNA of this business. They are deliberately re-architecting their entire financial structure to be more resilient, more predictable, and far, far less dependent on the whims of the macro environment.
Okay, so we've examined the foundation, we've inspected the engine, we've reviewed the expansion plans, and we have stress-tested the single biggest risk. Now it's time to put it all together. We are going to lay out the final blueprint, weigh the bull case against the bear case, and forge our verdict. Is HealthEquity a genuine opportunity, or is it a trap?
All right, the bull case is powerful, and it's built on multiple pillars of strength. 1, you've got a company operating at an elite Rule of 50 level. 2, you have a massive 700 basis point gross margin expansion that's driven by a maniacal focus on technology. 3, you've got 2 brand new, clearly defined growth pillars targeting enormous markets. 4, you have a management team that has brilliantly and proactively de-risked its biggest revenue driver, turning it into a durable recurring stream. And then the cherry on top. The stock appears deeply undervalued with a PEG ratio of just 0.35. Put it all together, and that is the blueprint for a financial fortress. But hold on, no fortress is impregnable. We have to look for the cracks in the armor. First, you've always got macroeconomic risks. If unemployment starts to rise significantly, that could slow down new account growth, since most of their customers still come through employers. Second, there's execution risk. The new marketplace and the HSA initiatives sound great on paper, but they are still in their early days. Management has to prove they can actually execute on these ambitious plans. And finally, while HealthEquity is the clear market leader, there's still competition from the long tail of thousands of banks and retirement companies who hold a fragmented but still very large portion of HSA assets. These are the headwinds you have to watch.
After weighing all the evidence, after stress testing that foundation, and kicking the tires on the risks, the verdict from Iron Financial is clear, and it is confident. Opportunity. The market appears to be fundamentally mispricing this company based on an old, outdated understanding of its business model. The fear of interest rate cuts is lagging the reality of the strategic de-risking that has already happened. The market is pricing in old risks that management has systematically engineered right out of the business. And that brings us to the final question that we're going to leave you with. With a fundamentally de-risked financial model, a powerful profitability engine, and multiple new growth drivers just starting to fire up, is it possible that the market is completely overlooking the financial fortress being forged at HealthEquity? The numbers, the strategy, the execution, it all strongly suggests that they are. As always, this is not investment advice. Our job here is to give you the analysis and the tools. It's up to you to do your own homework and forge your own verdict. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.